Hi guys, so in this video we're going to discuss part 2 of identifying gaps in the market. So of course in the previous video we discussed identifying gaps where you look at the chart and the market may have gapped up or gapped down and there's no candles in between, there's just a space there. Well, there's another type of way to identify gaps, and it's just by looking at certain candles. There are particular candles that will create gaps in the market when they are printed. So for example, you have a small bullish candle here, long bearish candle here. That is a gap in the market. It's also called an imbalance or an FVG, which is a fair value gap. And it's created by institutions, large corporations, banks, major banks, hedge funds, the people with the money who have enough money to actually move the market, not as little retail traders, but the ones who have enough money to move the market. So they are the ones who create these candles. And so that's one example. You can see it here again, small bullish candle, large bearish engulfing candle right after it. And then the opposite is true as well. You have a small bearish candle, long bullish engulfing candle after it, small bearish candle, long bullish engulfing candle right after it. You can see this happening all over the market on all different time frames all the time, right? And so just like I said in the previous video, just because you see the market gap down or gap up, you don't want to automatically sell or buy. You just want to use it as one of your confluences. It's like one of your weapons in your arsenal that you use when you trade. It's not necessarily the main reason you enter the trade, but it will become one of the reasons you enter a trade. And it's something that you want to always be aware of, because the market is always looking to fill gaps. So for example, I had a sell set up on US 30 that I called about 2 or 3 weeks ago. And price was still pushing up at the time, but I could see the sell momentum slowing down, and the buy momentum was slowing down, and there was a sell pattern, bearish pattern, that started forming at resistance. Now, what a retail trader would do is, as soon as price touches resistance, they're going to immediately sell. And so they're going to sell and they're going to place their stop loss above the resistance. And so that is not something that you want to do. The reason for that is because those large institutions, those market makers, they can see where your stop loss is. And so they'll execute stop hunts, or what's called a liquidity grab. And liquidity is a whole nother topic that we can discuss in another video. But basically, liquidity sits at resistance zones and at support zones. And so what institutions will do is they'll go stop hunt and grab liquidity above the zone or below the zone, and they'll fill a gap and then push price in the opposite direction. So when I saw the bearish pattern setting up at the resistance zone, I didn't want to sell immediately. I wanted to look to the left and see if there is a gap above that zone. And there is a gap above the zone right here at this level, right around that 34,800 level. That's why I ended up having an alert at that level that was triggered when price pushed up to it. And at that point is when I began to look for sales. And so that's the way that I use the gaps in the market. I use it as for potential entries and for potential take profit points. So if you were buying at this point, you could have used that level as a TP as your target. But it's not something that you always want to do when it comes to using it as your target, but it's most definitely great for entries, in my opinion. So like I said, it's a very extensive topic, and we can really discuss it for a long time. Really, it can really get deep. We can really talk extensively about it. But if you want to do some research on your own, I recommend the one who created Smart Money Concepts and Institutional Trading. His name is the Inner Circle Trader, or ICT. You can check out his YouTube channel. He has a lot of information on it. A lot of videos that could potentially explain it better than I can. But that's just one example of how I use gaps in the market and imbalances. And so, yeah, that's about it for me, guys. If you have any questions or anything,